Well, top of the morning to you. I guess it's not morning anymore, but we are convened here this afternoon on Friday, the 12th of January, to kind of kick around a little bit with our beers in the back, talk a little bit about the USDA reports today. Big report day, often is for this January WASDE. We get the normal WASDE, which includes the USDA's final production numbers. We also get our DS1 stocks numbers. We also get our winter wheat planted area. So this is a report that historically, it can knock the markets around a little bit, as it kind of did again today, as you saw. And I think, Bill, why don't you just start us off here and tell us kind of what you get out of this report, what the numbers were. Give us a little bit of a recap, if you would.
Sure. So we get as you mentioned, a monthly WASDE and then 3 more reports. So this is probably one of the top 3, if not higher, overall reports the government comes out with, and it's because they give us our final corn production numbers for corn and soybeans. They give us a December 1, a snapshot of stocks as of the December 1, and that's important to give you some idea of usage. And then the third thing is we get the winter wheat sitting, so it gives us an idea of how we're launching into the next year. And it can come up with some pretty healthy surprises. I would say generally these were on the bearish side today in this report, given an upward revision to the corn crop through yields, an upward revision to soybean production as well, and stocks probably in line with those numbers. So I can go through some of the detail on that.
Sure.
Now.
Yeah, you bet.
Okay. So the production number for corn finished up another 116 million bushels larger, so 15.34 billion. They took harvested area down, but that was offset by yield. So the important thing there is maybe not today what that means for us, as much as what it means when we go into 2024 and beyond planting conditions and we see stressed crops that don't actually result in lower yields. This is the yield the resilience to bad weather of these hybrids give us yields that are pretty remarkable. The same thing happened on the soybean crop. We had pretty adverse weather the last 30-45 days of the growing season, and we still ended up with production being revised in this number up by 38 million bushels, I believe, 36 million bushels. And both of these were larger than what the trade had anticipated. And again, yields were revised up, but acreage revised down.
That 50.6 soybean yield, that is, going from memory here, that's within a bushel an acre of trend yields, which to your point was pretty bizarre because we had a strange growing season. I think we had one of the driest Mays on record, certainly did out here in the Western Corn Belt. First half or 2/3 of June was dry as well. Then it rained like hell late June and all of July. And then we didn't get any rain to finish the crop off in August or later. So kind of, it is pretty remarkable, isn't it?
So it finished up very strong given the kind of weather we had.
You think we're going to see that in South America? I don't want to get off the track on the report here, but everybody is just doom and gloom and it's horrible. Or I shouldn't say everybody. There are some, USDA's not so much, but about how bad it is in Brazil. Well, the weather's gotten pretty doggone good the last 5 or 6 weeks. Wonder if we're going to find out that the crop did all right.
I don't know. I mean, the people on this call aren't the only ones that understand that these crops are resilient to bad weather. So that's probably baked into those numbers to some degree. I would say 5 years ago, we'd have had a much lower estimate for these crops, and people are saying, no, hold on. It may not be quite as bad as we presume it to be.
Yeah, no kidding. Yeah, you look at Brazil and you have I can't remember who the heck it was. I saw a estimate this morning for Brazilian bean production under 150. Cordonier, I think, is down around 151. The USDA today was 157, although they're usually kind of, I would say, not being critical at all, but trailing the play a little bit when
Yeah,
it comes to South America. But
they came down in Brazil and they went up in Argentina, and both of them
yeah,
realistically they could have gone further in. I think that's still to be determined. January 12th here is the equivalent of July 12th in the other hemisphere. So we've still got quite a ways to go before we can say with some assurity how good or not good it's going to be.
yeah.
Yeah, it was the consultancy Patria Agro something that I can't pronounce. Nobody we've ever heard of before came in at 143.1. And like one of our customers made the comment, he says, well, you don't make headlines if your estimate is in the middle of everybody else's. You kind of have to take a bit of a step out if you want to get headlines, which this outfit did. But yeah, that was they are a bit under the USDA.
Yeah, so if we home in on the stocks report, I think if I'm hearing you right, Bill, the stock side of this kind of fell in line with the bigger production numbers on corn and beans.
Yes.
In other words,
yes.
we made a little bit more, and there they are in the checking account. Life is good. What about the wheat side? I mean, Scott's not here with us today. He's on vacation, but I don't want to shortchange the wheat side. So first off with the wheat stocks, and then tell us what you made of the wheat acres.
Right. So I thought the wheat stocks were on the little bit on the light side. And I think USDA has got an annual feed number of 120 million bushels overall. And I think it could be a little bit lighter. If there's anything in this report that kind of I'd throw a flag on it, was that hard red winter wheat may be a little bit tighter than we realized. More usage in the mill grind, and generally overall stocks ended up lower. Those are pretty hard to put a lot of definition on, but it certainly did seem like we were on the light side of where we could have been for overall wheat and specifically for HRW. We're still if you merge that into a reading of the tea leaves, you'd say, okay, we've had more continued poor export sales, and we've had improvement in the weather conditions there, and we haven't been able to push the HRW market below the $6 level. And maybe that's telling us something about where we're going to be, how long it's going to take before we can go significantly lower in the wheat market.
So your assessment is the hard red winter wheat balance sheet might be a little bit snugger than we thought. I think we all kind of got a little bit more comfortable because it doesn't look like we're exporting much, but the wheat doesn't seem to be there now. Isn't this the second stocks report in a row that was kind of the case? It doesn't look like the wheat that ought to be there is there in the checking account, so to speak.
Yes, not to any alarming degree. I mean, it's a matter of how much, is it moderately bearish or is it flaming bearish? And it's right now it's just moderately bearish, so it's not quite as much of a
Bullish, you mean?
Yeah. I'm sorry. Well, I think yes, correct.
Yeah. Yeah, I had a customer ask me a little bit ago, well, if the wheat numbers in general, the stocks and the acreage numbers are a little bit friendly, why is wheat down? And my answer was because everything else is getting the tar beat out of it. Corn was down when we walked back here to start doing this. Corn was down double digits. Beans were down close to 30 cents. Now, beans had bounced back a little bit off the lows. I think March soybeans got to 12.03 and then bounced back. They were 5 or 6 cents higher than that. 5 or 6 cents higher than that earlier. So
you asked me about the acreage.
Yeah.
And
I don't want to short shift wheat. Scott will get mad at me.
No. We don't want to do that. It is the an important grain. So we're overall the acreage estimates we're down 6% in acreage, fell below the average trade guess. So we ended up with I won't say significantly lower, but quite a bit lower than what we had, where we thought we would be relative to a year ago, and the trade was trying to fade it lower, but didn't fade it low and hard enough. Most of the big delta is in HRW, so 6% decline. So wheat's a tricky one because you can't count on farmers harvesting it. And last year, harvested percentages are very low. And if you have normal weather, you're going to see that rebound to a more normal level in 2024. So I've got a USDA number today of 6% lower HRW acreage, 24.0, but a crop that I've projected to increase by 21% to 730 million bushels. So if you return to normal weather and normal percent harvested, you get a much larger crop. So, all is not lost in the wheat market. And, I suppose we can still have weather, the weather, adverse weather. The weather has improved quite a bit there, so I'm favorably impressed with that. The increase in wheat production in 2024 will not be as big as I thought it would, but we still basically are not competitive in global markets. So, like I said, the push for the market to go lower has been stalled, it seems, for now, and this report probably keeps it that way. Not that it's a bullish report, but I would characterize corn and soybeans as neutral to bearish. Now I would characterize wheat as fully neutral.
Yeah, that makes a lot of sense. I think one of the questions that comes to mind is, why would hybrid winter wheat farmers why would they plant less? We had a pretty good, better moisture coming into fall planting. We had decent prices. I mean, at least historically, maybe that's the problem is they're decent prices historically, but they're way the heck below where we were when they planted the prior year's crop.
Yeah, I mean, what happened a year ago that we ended up at a larger number. You had higher prices. It may be just enough of a dinger on that. Some areas cotton will gain you a little bit. Farmers generally are looking for a reason not to grow wheat. And spring wheat's different, but in the winter wheat areas, they're generally looking for a reason not to grow wheat because you're trying to find something that's better than wheat in terms of a return to production. So that may be a part of it too. And this is obviously subject to revision. This is the January 12th report. We'll get another update on acreage on March 31, and then at the end of June as well to revise these numbers around.
Yeah, Nate, did anything that you took from this report? I noticed USDA did lower the soybean oil ending stocks.
Yeah, I think to me, I mean, we came into this year a little bit worried about soybean stocks and what that means for crush, and the fact that now we've found some more soybeans. They took ending stocks up to 280. I think that has to make us feel a little bit better about soybean supplies. I mean, we're by no means fat and happy, but definitely sitting a little bit better than where we were to start the year. I mean, that's been one of the concerns that a lot of the crushers have talked about, not just on soybean stocks, but also the whole meal exports and what is that going to mean for margins. Mm-hmm. To me, this kind of takes the soybean thing maybe a little bit off the table, especially with some of these new crush plants coming online and the extra demand that's going to put on things. But
we've long said that we have a lot of soybean oil, veg oil buyer customers that are probably watching this, and we've long said that the soybean oil buyers nirvana, you need two things to have happen. You need enough beans to crush, and you need enough meal demand to drive that crush. And so far, so good, I would say, on both categories. I mean, it looked like, before we got into harvest with this bad finish that you talked about, Bill, to the growing season last year, I think there was a lot of concern about, are we going to have enough beans to run these new crush plants to make enough oil? Or is this going to turn into an oil problem? And I think the bean thing has kind of slowly and quietly fixed itself as we've gone through this objective yield survey process. So look, we found a little bit more production, and even though offtake is good, well, I would say domestic offtake is good. Crush has been better than build. Exports have certainly been worse than build.
The one thing that's interesting, last week when Scott and I were down at FarmCon, that Kevin Van Trump conference, and there was probably, I don't know, 1,000, 1,100 people there. And I would say 85, 90% of them were farmers. Kind of polling the crowd, everybody was still of the mindset, I'm going to lean heavier on corn acres than soybean acres, just because, as we've been told by Farmer Dave, farmers love to plant corn. With this price action on soybeans, the market, and I know, Bill, you kind of discount a little bit the whole notion of the corn soybean ratio, but the market really isn't giving the farmer any real compelling reason to want to plant more beans. I don't see. I mean, it doesn't look like, if you looked at the futures market right now, you wouldn't say we have a tight soybean balance sheet, I don't think. But, and who knows what that looks like once we get to March. But that, to me, that might be, and I don't want to say concerning, but when you're sitting right here with the carryout we have on soybeans, we can't really afford to have any kind of issues.
Well, that's true, but I also think that, maybe said a different way, I think when you look at the price relationship right now, at least for that Iowa or Illinois farmer that's going to lean heavily into his rotation, there's really nothing in the price today that says that he should get out of rotation.
Right.
You know, he was corn last year, he's going to be beans this year, and vice versa. And there really isn't anything. We're kind of in that normal band, if there is. I wonder if we've lost Bill here, because that, or he's gotten a very
He's in
consistent
deep
stare.
thought.
He's in deep thought.
No, I'm here.
Oh, there he is.
Okay.
Okay.
Your screen kind of froze. You kind of looked like you were in deep thought for about the last 90 seconds. So, but yeah, Bill, do you disagree with that? Is that, does this change your outlook with what we've seen on price action with what the farmer's likely to do next spring?
No, I think you're within the boundaries of what normal relationships would be. And, farmers have to think agrologically. I mean, they have to think, okay, I've got this many tractors, this much tractor time. I got to spread my harvest out. I got this much storage. I've got, if I go out of rotation this year, that screws me up the next year. They got to have a reason to do that. And I'm looking at today's producer price index for nitrogen off 39% from a year ago.
Yep.
So the price of nitrogen for a farmer is off 39%. And that's not even going into the fact that last fall we produced had quite a bit of fall nitrogen place that locks them into a corn crop. Diesel fuel prices are off 19%. So that affects both corn and soybeans. But if you don't penalize the farmer for producing corn, I think Nate put it well, that's kind of what they want to do.
To me, I think the bigger shift in acres, and not to get out in front of ourselves too much because we have March to look forward to yet, but the bigger shift in acres, I think when you look in the Dakotas right now, like sunflower prices to the farmer are very, very weak, mainly because sunflower oil prices have taken a lot of, have been impacted a lot by imports coming into the U.S. And I was talking to Dave Mack, who is a bit more of our sunflower expert, and he said, if you're a farmer in the Dakotas right now, why would you plant sunflowers? I mean, you're going to look at something else. So I think if we're going to see a shift in acres in March, we're going to probably see in some of these fringe areas, people maybe not being soybeans in favor of corn, but switching away from some of these other crops back to corn or soybeans, possibly where you can make some more money. But I think all in all, I mean, when you look at the report, I think everybody, as we kind of said last week coming out of FarmCon, everybody was kind of thinking we'd find some more corn. We found some more beans. It's probably viewed as a little bit bearish, but I think as far as what we do for the customers that we work with, this probably isn't a real bad report. I mean, we have more of the things we need, and all is well.
Yeah, and I think maybe to start kind of putting a bow on it on the call here today, I think when you look across the complex, when you look across the three commodities that we're talking about here today, I don't know that this changes corn outlook much. Yes, we've got a little bit more corn, but we have plenty of corn. USDA is almost 16% of use. I think, Bill, you got an even higher ending stocks forecast. So added a little bit of corn to the pile, but the reality is the pile's large enough that probably doesn't significantly change anything on corn. When you look on beans, I think, your point, Nate, and Bill made it as well. We have a balance sheet that seems like for the last handful of reports here, we have gotten less and less and less worried about soybean ending stocks. But at 280, And I know, Bill, I think you're still over last numbers you published. You have an ending stocks over 3. I think you got a considerably lower export total, which seems to fit the pace data better. We are getting, I wouldn't say 280 is anywhere near comfortable, but we're getting where we have a little bit more tolerable, a little bit more breathing room, I think, in the soybean balance sheet, which, when we've been crushing for oil, like we've been crushing for oil here for a couple years, that makes you feel a little bit better about the oil balance sheet. And then I think when you look at wheat, I think we might have snugged things up a little bit, but those are great points you make, Bill, on, if weather stays good, and we had a pretty rough weather year last year on especially hard red winter wheat. If the weather stays good, yeah, you lost a few planted acres, but you might kind of make that up in yield and harvested acres, or more than make it up. So safe to say that we probably, I guess we always learn something on these reports, but I don't know that it changes the longer term perspective of where these crops are. We didn't find out today that we have a problem somewhere. Would that be a safe assessment?
Sounds like a good
Yep.
bow to put on it.
Okay. Well, and I think anybody got any closing thoughts here? We good?
What the funds are, have taken up pretty big residence in the short side of things, and so that leaves you vulnerable probably the next 60, 90 days for some kind of bounce back. We're already talking about
Yeah.
terrible weather events in 2024, that's ludicrous to be thinking about that this early. On
That's
February,
illegal, isn't it?
it's illegal not to do it. February 15, 16, USDA will have their outlook for them, and they will give us their first in print, or it may be better put, an update of what they think the outlook is for the next crop year, the 24-25.
Mhm.
And I don't think you can manufacture numbers in that won't be bearish. I mean, we're going to have that report likely shows us a growth in corn, soybean, and wheat ending stocks at the end of the next year. So we're, to think of it, we're turning back to the page back to a more normal situation.
I tell you what, after the last 2 or 3 years, I think a lot of people, myself included, might have forgot what normal looks like. But we have called that out to quite a few of our customers of, look, what we've experienced of the last 2 or 3 years is not normal. You go through these periods in the commodity business where it almost gets boring. I mean, there's always something going on, but where you just don't have the insane volatility that we have kind of gotten accustomed to. So, looks like in the U.S. and the world, we've kind of fixed the corn supply problem that we've been living with the prior 2 or 3 crops. Looks like even though with what's going on in the Ukraine and the crappy HRW weather we had last year, looks like the market's kind of figuring the wheat thing out. And, maybe we're kind of one more growing season, that being the one that's underway right now in South America, kind of one more growing season from maybe normalizing soybean supplies a little bit. So hopefully we can get to, some little less hair-raising times of the commodity business like we've had the last few years. So I think this report kind of continues us down that road is kind of how my takeaway from it. So last question, Bill, and then we'll break it up here. You were talking about acreage a minute ago, and I know your past counsel to us has been the next planting cycle, and maybe it's illegal to talk about that in January too. Maybe we have to wait for March 1st. But I think your counsel has been less corn acres, more bean acres, but that is not the anomaly. Last year's big corn acreage and low bean acreage number was the anomaly. And so you've kind of said you're looking for a return to more of that normal acreage mix in the U.S. Is that still the case?
Yes, I'm kind of, I could throw a couple of caveats in there that, we got a lot of fall fertilizer down, and returns have, improved with the lower input costs for corn. So I think that's what will be happening: 2 to 3 million less corn acres and 2 to 3 million more soybean acres. But I don't feel a great deal of comfort going too far out on a limb there. We'll keep the pie the same, but switch at least a couple million acres out of corn and into beans.
Yeah, there's a lot of water to go over the dam yet. Between now and when a farmer's going to make that final decision. So I'm sure we will probably have a beers in the back to talk about the end of March intentions report, planning intentions report. So, well, that's what we've got for you today, folks. Appreciate you listening and watching. Any questions you might have, just go ahead and give us a call or fire an email over. And as always, in these crazy commodity times, be careful out there.